Variable rates are back. We have consumers taking variable rates right now, and we are starting to see 5-year mortgage rates go below the 5% magic number, and some lenders are actually making it a little bit difficult, one in particular, for their current clients to renew their mortgages. All this and more with a good friend and mortgage broker, Mr. Dion Beg, right after this. Here we are, my friends, with our favorite mortgage broker in all of the land. How you doing, Mr. Dion Beg?
Great, Gary. We had some exciting non-news in the past week that I'm very excited to discuss.
Excellent. Excellent. The excitement is overpowering, my friends. We said it here last week. We probably, or at least Dion has been saying it for perhaps a good month now. The Bank of Canada did what?
Yeah, they held rates yet again. So one more sigh of relief for Canadian mortgage holders and anybody with any kind of credit debt. So yes, we're still at this 5% rate, which they've been at now for 4 months in a row, and we're going into Christmas. And again, it pretty much is in line with what everybody had expected, especially based on the economic data that come out in the last couple of weeks, with employment numbers being quite low, retail spending numbers being quite low.
Yeah, exactly. And all the pundits out there, other than us, they're suggesting that perhaps another rate hold for January. Of course, if you've been educating us, nothing in February. There's no announcement or no scheduled announcement, which means March. March might be our first reduction, as it may come in March.
I could say this, and this is what I say to all my clients: we can hope for it, but don't bank on it. In that, it wouldn't be totally off the cards for that to happen, but don't make buying decisions on a potential rate decrease in March. But yeah, certainly sometime next year, I think it would be very reasonable for us to expect a downward tick, and a continuous downward tick over time in the variable rate, as more economic data comes to the point where the government, the Bank of Canada, says, you know what, we did our job. And I really do feel like, in the people that I'm speaking with and I've been speaking with over the last year, some people are at breaking point. And so if we keep pushing harder, they are going to break. We're going to somewhat maybe break some components of the economic system that keeps everything going here. So again, it's a hard balancing act for the Bank of Canada, but I think what they're going to continue to say is what they have always said, which is, we have not raised interest rates, but we have no hesitation in raising rates again if we need to. So don't be surprised if that's the messaging that continues to come out of the Bank of Canada press meetings, regardless of what they actually do. They want the messaging to still be, oh no, don't get too excited, Canada. Don't go buy everything. Don't go run up more debt. Don't run up more mortgage debt. But their actions are what I'll be watching more closely.
Yeah, and there has been on record a couple of banks just get slightly below that 5%, kind of that magic 5% interest rate over the last week or so, and that's really based on a few things. Obviously, some of the things you're mentioning there, but as well as mortgages. If you're not in the know, if you will. They are tied to our bond rates, and what's happening with the bond rates over the last couple of weeks.
Sure. Let's throw up that slide, Gary.
Excellent. Let's do this.
So a couple of months ago, you and I spoke about the fact that for the first time in a very long time, the Canadian 5-year bond yield cracked 4%. And that pushed our interest rates up into the high sixes, almost at 7% on a regular 5-year rate just a few months ago. So if I'm to point that out on this graph here, we're looking just a couple of months back at a bond yield rate of 4.4%. And since then, as you can see, we've had this relief, and now we're hovering at around 3.5. So we've dropped pretty much a full percentage point on that bond yield. And we have seen that translate to much lower rates, especially on that 5-year rate. And as much as I'd love to say that banks have passed on that full 1% drop to their customers at the retail level, as always the case, when interest rates go up, they will pass that on at the speed of lightning. But when interest rates drop, when the bond yield drops, it doesn't follow as quickly. And I understand why, because they're wondering, if is this a flash in the pan, or is this a trend they can depend on so they can price their money accordingly. I feel like, again, we're going in the right direction. And even though we haven't dropped a full percent, over the last month, we've probably seen about a 0.5% drop across the board for most lenders on that 5-year rate, and a little less on the shorter term rates on the 2 and 3 years.
Gotcha. Gotcha. And I know a few months ago, about 3 months ago, in fact, when I renewed two of my mortgages, I took 1 year fixed rates, in the thinking that in a year from now, or 18 to 24 months from now, the rates will be lower. And I know over the last month or so, that trend has actually swung back to taking some variable rates. Is that what you're seeing? Do we see clients doing that?
Yep. So the variable rate was like a dirty word for the last 12 months, right? Nobody in their right mind would take a variable rate in the rate environment where you just don't know what the Bank of Canada is going to do, and if recent behavior is a guess of the next behavior, it's probably going to go up. So most people were taking shorter term, 2, 1, 2, and 3 year fixed rates. But you are correct, Gary. In the last couple of weeks, in particular, we've seen clients who have been really watching rates very closely, now coming back into the market and taking that variable rate, in the expectation that they'll be able to ride that rate down. And I can also tell you that I've seen a lot more activity just in the last couple of days, in advance of the rate announcement and after the rate announcement. A lot more clients who are coming out saying they're seeing the same things that you and I have been talking about, Gary, which is, you know what, we're likely at the bottom of this cycle, or sorry, at the top of this cycle, and therefore they're actually getting pre-qualified to buy over these winter months. And they expect that the March and April spring market may be a market that they'd rather not be in the middle of. They'd rather try and buy in advance of that April May market. So they're actually getting pre-approved to buy December, January, February right now.
Excellent. Excellent. Good stuff.
Yeah.
And then we have some banks like sometimes our favorite and sometimes not our favorites. Scotia Bank kind of just, I don't want to say making up some new rules, but perhaps, you know, hedging their bets, if you will, and fixing some of their internal procedures. And talk to us about what's going on there.
Yeah. So, yeah, let me give you some background context first. So, Scotiabank, about 12 months ago, decided to refocus their business on getting more deposits into their bank, and actually lending less on the mortgage side. And I can tell you from my perspective as a mortgage broker, I can tell you that during 2020, 21, 22, Scotiabank was very aggressive with their mortgage lending, in that they were out there to secure as much market share as possible. And we use them a lot in our business. We still use them, of course. But what they've done in the last year is they've really sort of dialed up their interest rates to the point that they admittedly sort of priced themselves out of the market in certain segments where their rates were not quite as attractive as others. And again, they were really focusing on building up their deposits to rebalance their books, because frankly, their deposits were quite light compared to some of their competitors. They needed to rebalance their situation. Now, what's happening now, and what was published this week, is this idea that Scotiabank may be deselecting clients at time of renewal. And when you read that, as when I read that, I was a little bit puzzled, because in all of my time in this mortgage business, as long as you as the borrower had met your obligations and paid your debt on time, paid your mortgage payment on time, that lender would always renew and give you the option to renew. And I want to be clear here, that will likely still be the case for 99.9% of people. But I will say that I have seen lenders renew into situations where they weren't really obligated to. So let's say we had a client who had a medical issue, they had transfer of payment missed because of some medical issue, and so therefore they missed their mortgage payment. At time of renewal, I've seen most lenders let an incident like that slide and say, you know what, that's okay. We understand the circumstances around that, and so we're going to let you renew as we would any other client. The way that this has been put out there, it seems that they're going to be a little bit more strict in regards to who they renew, and maybe the rates at which they offer renewal. So it may not be the case that they say, no, we're not going to renew you, but they may be offering you interest rates that are very unattractive compared to what that client might be able to find at a different lender. And so they may actually be choosing to push those clients out, not directly, but indirectly through the way they price these renewals. So it's, again, not something that I've seen before, but again, in the context of what Scotia's been doing in relation to rebalancing their books, I can understand why Scotiabank's taking that approach.
Yeah, it's interesting. Something that we need to keep our eyes and ears open to, because I'm actually a client of Scotia Bank, and I know many people are. And when things do kind of swing, we've often said this: the pendulum is on one side, and when they trying to correct, it's usually swings to the other side pretty quickly.
Too
So
high.
we just got to be we got to be aware of that, especially when government tries to get their fingers on stuff. You know.
Yeah,
Okay, so we've been talking about this different provinces across Canada, and different legislations, and whether it's at the federal level or at your local, city or township level, we need more density. So tell us what's going on in BC.
yeah.
This is pretty neat.
So before I jump to that, Gary, maybe you could tell the audience more about what happened in Toronto earlier this year, and then that'll give us some context for BC.
Yeah, definitely. So, what happened in Toronto is there was a new bylaw that came out, that was introduced and came out because obviously in Toronto, excuse me, we have a density issue where we need more housing, just like many, many parts of Canada. And what happened was every property got rezoned, or is in the process or being allowed to have up to 4 units in each property. Some can have slightly more, and this is a big swing because now you have municipal or local municipalities changing the way that they think. So the suburbs. Okay, well, if
Yeah,
the big city of Toronto has done that, what should we be
yeah,
doing, and can we move as fast? And that's what you're starting to see even right across
yes.
Canada.
Exactly. And so what you're referring to was a decision from the city of Toronto, specifically for the city of Toronto. But when that came out, we had sort of speculated how this would then roll out across the province and maybe across the nation. And so, again, if you just want to share this slide here, Gary.
Hmm.
Um, and so this is a big announcement over the last couple of days. Yep. So the BC Premier has announced a roadmap for adding 250,000 homes over the next 10 years. And the way they're doing that is pretty much in line with what the city of Toronto has done, which is basically blanket all properties and zone them now as a fourplex allowable as a given, right? So every property is a fourplex by a given. And this is not on a municipal level. This is on a pure provincial level, the entire province of British Columbia, and this is to be coming into effect in June 2024. And so, in reading this and in listening to the commentators around this, basically the premier of the province has said, "Okay, I know all of you municipalities and all of you mayors need to get reelected, and the minute that you talk about rezoning or densification of property, from a high level, most people understand it. We need to create housing, but when it comes to it happening in your backyard, that is when people will have major resistance, and that's where local politicians are worried about how their constituents will will obviously react to that, and then they're fearful of their own position at time of re-election, right? And so I think that basically the BC Premier has basically said, I'm going to fall on this grenade for everybody, right? I am going to be the one who's going to say, this is how it's going to be. And I'll be the bad guy. And you guys at the municipal level, you get to save face. You just have to implement my decision, right? So that's the case. And just to be clear here, it's 4 units on pieces of land that are over 3,000 square feet. So that's not a very large parcel of land at all, Gary, right? 3,000 square feet, that's 30 by 100. That's a standardized suburban lot. And then the larger the lot and the closer you are to hubs of transport, that densification increases by levels, number of levels. So you can go to 8 floors and up to 20 floors the closer you are to modes of transportation. And so all the things that we've been speculating and asking whether or not this would happen, you know what, Gary? It's actually happening. I'm going to say it's because of the discussions that you and I have every week.
I think so. There's people watching and listening for sure, and it reminds me though, like you still have people that in one way are against this, believe it or not, And I get it, but I also don't get it. And the funny thing is, there's this funny little meme that's been going around. Hey, they got to live somewhere. These our friends and family have to live somewhere. Propose a housing development in your next door
Yep,
neighbor or your backyard. Yeah, but not here.
but not
And,
here. Yeah,
right.
yeah.
And that's the mindset that people have right now. I can think of areas right here in Stouffville where homes back onto, let's say, a main street or a main thoroughway, a main road, and there's lots on that road, that particular road, that are perhaps 50 by 200, and they've been bought by a
Yep.
developer, of course, because there's one single family home. It's underutilized, that land, and they want to redevelop that to put multiple um, dwellings on it. And of course, the NIMBYism is at a peak level in
Mm.
that area. And yet there's also the same people that will, in the next conversation, say our housing's too expensive.
Yes, yeah. So you
Where
can't
where are my kids
have
going to
your
live?
cake and eat it. Yes, yes. So I don't know if we've discussed this, but I've actually personally been impacted by what you're seeing on the screen there. In that I bought into a very established neighborhood. I have a large backyard surrounded by trees, and but I knew that there was development slated for construction in some years ahead, and that eventuality happened. I went to the government meetings around it so I could be aware of what was happening. And the reality is, yes, I did lose quite a bit of sort of a forest view from the back of my house. And so that's the negative. But the reality is that I can't really be in this industry, an industry which is in real estate, and be against the development of housing. It's something that again we need. And as much as I did feel the gut reaction of the regular NIMBY as I sat down and processed it all, I said, in the long term, this is what our nation needs. We need more housing. And so I'm not going to stand in the path of that. I went to those meetings to be an informed resident of the neighborhood. And I can see that they're doing everything, within the scope of what's allowable. So it is what it is.
Yeah, it's
Mm.
part of evolving as a community, as a city, as even as a nation and so forth. And we can get into a lot of different things here, but at the end of the day, we need more housing. More housing equates to, the majority of the time, more affordable housing, of course. And I know some of the projects that myself and some colleagues are looking at is affordable housing, and we can only
Mm.
obtain that by more housing.
Yep.
Yeah.
Yep.
Yeah.
And we've got to understand that that may come with some trade-offs that we're going to have to accept. Yeah.
Yeah, yeah, exactly, exactly. Okay, we're gonna end with this, and I'm gonna keep it at a very, 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 very high level. Last week we touched on what does gold mean to real estate and vice versa. And we kind of said that sometimes gold is a little indicator of what's going on in our real estate world. And I won't I'll leave the charts for another conversation. But if you want to
Sure.
look up, here's what you need to Google. Here's exactly what you need to Google: gold and housing prices. And there's a
Mm.
whole slew of different reports and everything from news articles to actual university professors providing all this information. And there's a tie-in to where the gold price is and where our housing price is. For the majority of the 1900s, gold and housing prices were in line with each other. You see, typically most people will think that there's two asset classes, which is real estate, hard asset classes, which is real estate and precious metals in this case being gold. uh, they are, for the most part of the 1900s, they were in line with each other. So 1900 through, call it 1970, 1980. And then as the market kind of tanked a little bit in the real estate world, guess what went up? Gold.
So go. Yeah.
Right? Because people had less faith in the housing market, and then when the housing market tends to take off again, people start letting go some of their gold, and that gold price will come down. And what we're seeing right now is, of course, last couple of years, our housing prices have took off, and people,
Mm.
those gold investors, saw something that perhaps the rest of the world hasn't seen, or
Made him a little bit nervous, you think?
a little bit nervous. And they started,
Yeah.
you know what they've started doing, because of the housing prices took off so fast, they've actually started putting their money back into gold. And I think we're about to see is a shoot up in gold prices, which we have seen somewhat, and our housing prices just kind of tail off a little bit. And I think for the first time in about 40 or 50 years, I'd have to double check that 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 appreciation line will cross and it'll be about the same. So watch for those gold prices. As those gold prices move up, our housing should level off a little bit, which is what everybody's been asking for, right? For even since
Right.
back to 2016, 2017, we had a little lull there for a couple of years and then it shot up again. We just want stable pricing,
Interesting. Yeah. Yeah, because as it relates to this sort of the convergence of, say, the stabilization of interest rates and the softening of house prices, what this represents is potentially a good time as a buyer.
Mhm.
Meaning, if prices are going to soften, and I don't think they'll soften for long personally, but if they're going to soften now, or these next 6 months will probably be the window in which we might have this sort of convergence of rates dropping and house prices dropping at the same time, which is very rare.
Yeah, yeah, and I should correct myself. That the last time it made a cross was 2008. And this is why this
Ah,
is important because we all
right.
remember what happened in 2008. And that was the
Yeah.
last time that gold appreciation price, that gold price fell below the real estate valuation. I think we're going to see that cross again here moving into 2024.
If I
Yeah,
had a time machine, Gary, I'd go back to 2008. I'd just buy everything, right?
right?
So if
Yeah.
what you're saying is we're entering a similar time, well, that's pretty exciting.
Yeah, some
Yeah.
interesting stuff. All right, my friends. So, uh, look for interest rates to stabilize into 2024. Uh, look for that variable rate mortgage. And of course, Dion, people need to be able to get a hold of you. How does that happen?
Yes. Yeah. Kangamortgage.ca or on Instagram at the Dion Beg.
There you have it, my friends. That's Mr. Dion Beg. I'm Gary McGowan. We'll see everybody in the next episode. Goodbye for now.